Today's September 5th, and it seems that there is a lot of frustration around in the fact that equities did not fall sharply out of bed today. It is Tuesday, September 5th. Now, if you look over at X/Twitter, just give an example from Bespoke. They say here, rates are up, oil's up, dollars up. What gives? And Bespoke is not a knock on them. They're provide a lot of great content and material, and they share a sentiment that is kind of across the Twitter sphere, as we mentioned before. So what is going on? Well, we want to talk about options expiration. And as you can see here, we have the size of options deltas by strike. This is a great way to measure options positions. We have calls in orange and puts in blue. And what you can see is that next Friday, the quarterly options expiration of September is a very large options expiration. There are very big options positions. And so these options positions create a lot of gamma, and that gamma makes markets sticky. And as you can see, this expiration is much bigger than any other expiration we have going out to December. So if we break this down as we did in our founder's note for this morning, again, Tuesday, September 5th, you can see that the gamma is very concentrated at the 4,500 strike and 450 in the spiders. And what that does is it creates a lot of hedging flows that revolve around these strikes. Now, gamma is highest for at-the-money options, and it increases as we move to expiration. And so as we march forward here, that gamma should increase and only kind of make things a little bit stickier. And even if we start to break down a little bit, we don't think you're going to get a big volatility explosion yet because of the stickiness of this gamma. Now, the way that we measure this is with our implied one-day move. So a lot of people talk about positive gamma, negative gamma, and what that means. We just boil it down for you and say, hey, this is what you should expect based on gamma. And today, our range for the day, this is from the open to the close, was 68 basis points. And we would anticipate tomorrow, that is Wednesday, Thursday, Friday, to kind of be the similar picture in terms of daily ranges. Now, where things could change, and if you really want to start looking at hedges, maybe early next week, because we have the CPI next Wednesday, that's the 13th, that plays into the big options expiration on the 15th, that's followed by VIX expiration and the FOMC on the 20th. And so if you kind of zoom out just a little bit here, what you can see is that we are very kind of quiet in this sticky zone, and then we're going to hit this period where not only is there a lot of catalysts, but a lot of these gamma positions are going to go away. So if you find this information interesting, head over to SpotGamma.com. We put a link here in the description and on the video where you can get a free 7-day trial of our daily notes, and you can see exactly what we're thinking every day over this very pivotal week that's coming up. And if you have any questions, you can also put them in the comments section below.